Hello, my dear traders worldwide. This is Gabriel again. So, welcome back to my channel, Forex.Real.Trader coaching sessions. And today we're going to talk about a very interesting, somehow rare bullish pattern. I'm talking about the piercing reversal pattern. Okay. What are the characteristics of this pattern? As you can see on the screen, this is a pattern formed by two candles, right? The first one is a strong bearish candle, okay, that continues in the downtrend. The second candle is a bullish green candle that opens, listen to this one, opens with a gap down, okay, compared to the bear candle. And it closes, the bull candle, the second one that I'm talking about, closes at least 50% or more into the body of the first candle. That is the reason, because it's very rare to see this particular pattern that perfect, right? So that is the thing here. Let me explain you on the graphic. Basically, we see here, okay, on this one, let's begin with this one here. We can observe that the bear candle, okay, we're coming on a downtrend. The bear candle closes here, opens, closes. And the next candle, when it opens, right? Okay, it opens here. It opens here and closes here. This is the gap that the theory behind this pattern talks about. This is the gap. Okay. Now, the another thing is how far the bull candle is going to close, right? It has to close at least 50% into the body of the bear candle. Okay. If we detect those two characteristics, apart from the fact that this is a reversal pattern, so this is going to be valid on a downtrend on the correction, right? To pull back to the bullish area, that is valid. Right? So let's observe the pattern on real charts. I must confess something. It took me time to identify on my MetaTrader 5 charts to identify this very particular formation, because it's not very common. Okay? And when you find it, you think that it's a pattern, it's a person, but not. It's an engulfing, or probably here the distance is not clear. Maybe it's a tweezer button. Okay, so it's kind of observation that we need in here. So let's look at the first pattern, the one that is valid according to the observation, is this one here. Look at this. My bull candle generates a gap of, let me tell you, the gap is around, this gap here is around, say, from here to here. It's not even a point, it's not even a peep, right? It's very, very small, but it's a gap. That is the condition. Always having a gap in there. So meeting this one, okay, the gap, so is the first condition. Okay. So I have here my, say here with this one, I have my gap. All right. So that is the first condition. Okay. So gap, right? Gap on what? On the bull candle. Okay. So the distance between the bear and the bull in here, and the bull being below, right? The opening, right? The open of this one. The open is below the close of the bear. That is the bull gap. Okay, first condition met. Now, what about the second condition? The second rule for this pattern says that the bull body must close within the body of the bear candle, minimum 50% or beyond, but always within the range of the body. Let's see if that is accomplished. The midpoint of this candle is here, around here. This is the 50% of this candle. And the bull closed above, all right. So say that it's around 60% and is within the body of the bear candle. All right, so checked. That is my second condition. The first condition is the gap, and the second condition is the 50% beyond, right? That's it, within the body. Perfect. Now, what is a third condition that is absolutely important to determine if this is a valid piercing pattern? That it comes from a downtrend. All right. And in fact, this is the downtrend. Okay. And here is the correction in order to what? In order to pull back up. Right. So it's valid too. So we have a downtrend. Okay. Okay. Or a correction. Okay. That's it. Perfect. Again, it doesn't mean that if I see a pattern like this, that apart from being very rare, sometimes you can have false breaks and divergence with other indicators, such as MACD. Let me show you. Here, let's insert a MACD. Let's insert a MACD here. Here we have this MACD 2 lines. All right. Let's see. Look at this. There is some divergence, right, in the lines. The histogram is okay. The histogram is showing me in this moment a bullish area, okay. But the red line is above the blue line, so that is a bear indication. So it's a semi-divergent signal in here. So for this reason, I gotta be careful, okay? But okay, when you identify, when you spot it, there are ways to trade. Let me show you an imperfect piercing pattern. This one here, this one over here, we can observe that there is a gap, but the gap is even smaller than the one that I just showed you. And the body of the bull candle closes not nearly the 50%. However, the pattern was valid because look at this. It went straight up. Okay, it rallied to the bullish area. Okay, let's take the one that I consider, and according to the rules, is valid. Now comes the question: how to trade this kind of pattern? Remember, always bear in mind that the important thing here is that everything has to be according to your trading plan, the rules that you already preset. So if based on the rules and you identify the pattern, it's a go, right? The thing is here, how to trade it. There are two ways, and one is conservative and another is aggressive. In this case, definitively, the best is to be aggressive, right? Because there is no too much room for the trade to breathe, right? To take the profits. So I'm going to set here, remember, patience and discipline. So this formation took 30 minutes. I am in the 15-minute time frame. So after 30 minutes and the bull candle has closed and you identify it and analyze all the indications, it's a go. So you place it, right? Your entry point here. Okay. This is my entry point. And I set now my stop loss just to see if it is a valid trade, right? So you set in here and analyze. Let's see how many pips. Around 18 pips. So I would need eventually, if I want my ratio to be, if I want my ratio to be 1 to 2, right? So if my stop loss is 1 and my take profit is 2 in that ratio, right? 1 to 2. It means that for my stop loss, I am, let me confirm, I am risking here 18 pips, right? So if I'm risking 18 pips, right, in my stop loss, it's because in my take profit, I am aiming the double. So that is 36 pips. All right. So let's see if, despite the fact that I detected this pattern, let's see if it is a valid pattern. So here I have, okay, it could be a valid pattern, not 1 to 2 in my ratio, but a little bit more of 1.5, still valid. So I would set my take profit right here, okay? But I insist, I need other indicators. I need a lot more resources in order to have a viable trade. The ideal here is to always place it right on the top, right, of the previous higher high. And that would be still, let's see, let's confirm, a profitable trade. Yes, I would be aiming 26 pips, risking 17 pips. Right. Is it still good? It's decent. All right. But if I go farther, it would never hit my take profit. Right. So this is somehow how we identify and trade these kind of patterns. But also remember, we always need other validation, right? And that validation is given by, as you see here, the MACD or RSI, right? Even Bollinger Bands, if the case, right? So that's all for today. It was a very brief, short video because this pattern is not very common. And when you detect it, you have to be very careful because its development is not that high as, for example, with 3 white soldiers, okay? So my people, thank you very much for your time. See you in the next video. Bye-bye. Remember, okay, just a little reminder, if you find my channel and information here important, relevant, please subscribe, like, and share. Thank you very much. See you around.